Josh. Hey, Josh. Come here, boy.
Wow.
Oh,
You
we're
gotta
already
be
going
joshing
live.
me. I gotta go.
Oh my God.
Where did that banker dog go? Yeah, Josh is not with us today. He has other things to do, which are much more important. Is that even possible?
Like what? What's more important than us?
Exactly. Hope he watches this. All right. So that leaves us with just three. It's the three amigos, and we have Daniel Hopwood, top right corner, who's trying to stop from yawning, but good job. Good job. He swallowed that yawn.
I eat yawns every Thursday morning.
Right.
Friday night for you.
It is early for him. Bottom, plus he was up late with the call. So tonight at the bottom we have Royce Nathan, our Royce Nathan Wells, that is our fearless leader, and Quanticus Maximus, and
having to come in and represent
Guru Fund Maker Royce Wells.
Rah.
All right. That's right. That's right. And I'm going to do the disclosures here. We'll say that we are not financial advisors. This is not financial advice. The information provided, although you may make money off of it, but we're not saying that we should do or anything that we say. We're just saying that this is for entertainment, and you should utilize a real financial advisor for any financial decisions you may make. So I just did a summary of
this is
what
Sparta.
That's right. And we always say, "Are you not entertained?" All right. Let's go on. Yep,
Well,
there we go. Let's go. What's that?
Said hopefully very entertained.
That's right. If not, we're entertaining ourselves. All right. So let's go on to the facts and figures of the markets. Dow Jones is stayed under 40 or 50 at 49,662. It was up 0.25%. Let's look at how algorithmic these markets are again. And I say this every week. So it was up plus 0.26. S&P 500, 6881, up plus 0.56. And we've got NASDAQ at 22,753 at plus 0.78. So we might as well say 25, 50, 75, just nice and, spread out there. Let's go to the dollar index. It was 97.62 as it makes its way back up. I wanted to say downtown. Makes its way up. That is the highest of the week. Crude is just under $65, which is basically the same as what it was last week when we met. We have gold at just under 5K. It may have crossed since we got on here, and it is on the way back up. Silver is on the way back up at 77.14. Copper is also on the way back up at 578. And then all the bonds are up. And a lot of this reaction is, well, some of it was before, is to the FOMC meeting minutes is what they call it. And it's where they basically get, when they don't talk about it during the rate cut decision, but then we get all the notes after that, which help us determine what they were thinking. It's like, what were you thinking? These are all the meetings notes. And some of the notes were surprising because I don't know if it was the majority, but there was a lot that said, we're going to pause for a bit, and then we may actually consider going up. And that was the big news, is that there might be rate hikes later in the year instead of rate cuts because of inflation and fear of higher inflation. That was the message. Don't shoot the messenger.
Do they not know what economics and how economics actually work? Get out of here.
It doesn't matter to them. What did that matter? It's whatever the agenda is.
Do not.
That's the narratives. I want to shoot the people.
Exactly.
It's like, just give them any reason.
That's right. Because they see the charts are about to go up or down. They have to make announcements to justify those movements.
Give them one reason to stay here, and I'll turn right back around.
That's right. That's right. That's like a chart. It's what the chart, when it met resistance, it said, give me one reason to stay here. All right. So, Daniel, fill us in on any other little tidbits from the markets that you had.
Yeah, I mean, they're, overall, when you really look at it, it's still from, we'll call it, November last year, late October. is we haven't really gone much of anywhere. As much as, we love being bearish here, or in Royce's case, bullish. Market's kind of stagnant. The one thing I will say is this is the longest we've traded below the 50-day moving average for a while, which in and of itself is not like, recession tomorrow or anything. But it's one of those things where, you don't reclaim it. It's not exactly the bulls are in control kind of
serenity now.
Action. Yeah, right. That being said, when you look at tech distinctly, it is not positive looking. And when you look at the Mag 7 specifically, it just touched its 200-day. Now, that being said, 200-day, big support area, could be a bounce. Not going to pretend to be a market wizard here. That's Royce's job. But when you look at, S&P, kind of stale. When you look at the equal weight S&P, it is going up. So, the rotation trade is still there, but tech is looking quite weak.
Excellent. I love it. Have you guys paid attention to Google from the previous week?
Not specifically.
I did once.
It's down some more. It's just barely keeping its Google L is just barely above 300. When we first started playing with it, we were trying to stay between 340 and 325, I think. So it's been bleeding. It's down more than 10% of its value since we started talking about it. But hey, don't worry about that. We're good.
It has blood.
It's not even getting close to bleeding. That's the bad part. Bleeding point is around 227. So we still got about $77 to go. It's about 20% more. Darin, that was for you. Oh, look, we're in the middle of February. No comment.
Yeah, I would not. We'll talk about
the
this.
end of February. What it was February 28th? What do you keep saying?
Nope. I said specifically the middle of February. We'll see. We will see how close we can get.
Okay.
Calling it from Thanksgiving.
Yes.
From downtown.
I was gonna say that's a long shot, huh?
But hey,
to clarify for those,
disappoint.
Clarify for those. What are you calling?
That basically things were going to be hot going into the new year, but make sure by the end of February you were out because things were going to start, cooling off. And literally, it went from January right after the inauguration. If you guys remember, after the bells I was talking about, and then February. From there, Google literally has dropped over 10% of its value, but we're not talking about that. No one's talking about that yet. Let's get to 227, then we'll start talking about it.
Okay.
Put that on your calendar.
But you're being specific about the markets or specific about Google?
Isn't it one of those 7 that we talk about? I mean,
the mag ones.
Remember? Yeah. Remember, if they're not first or last. So if they're going to be the first to fall, they'll be the last to fall.
They start the dominoes, in my opinion, but we shall see. So,
did you see?
All right, sir.
There's a new Ultra AI for Google now. I saw it on my email this morning. Ultra AI.
What's Ultra AI?
It's
better than super duper AI.
For regular people, you get regular Google AI, but for those ultra people, you get that pay for premium AI.
Like Michelob and Michelob Ultra.
Mm-hmm.
Yeah.
I didn't even know there was a regular Michelob.
What?
I may not can even get it anymore. You're probably right. You probably can't even get it anymore. There was. All right, so let's move on to fun Chinese facts. I mean, we're going to talk about the Chinese people. We're going to talk about some trivia here. What's going on, Daniel?
Yeah, so it's the last 2 days. It has been Chinese New Year here in Asia. So when you're in Asia, you get 2 New Years, apparently. And the second one is 2 days long. But so this year is the year of the horse. And on average, in the year of the horse, we return 6.3%, right? But because, astrology is quite specific, we're in the year of the fire horse, which means we will drop 6.8%. But as we all know, technical analysis is just astrology for men. So we will adhere to this quite well. And if anything, what Royce was just saying may indicate, at least at some point in the year, a potential 6.8% drop. Now, I'll completely caveat this with last year was, I don't know, whatever year. And we were supposed to like decline 2.4%, and then we were up, 16 or whatever it was. So, astrology.
Extend and pretend. Extend the fate of the fire horse until it has to happen.
It's like most years. We might be up, we might be down. We'll know at the end. Whatever it is, it'll be out of Darin's guess.
Well, yeah, I would say I was gonna, if I had to, I'd say, of course, more than 6.8%, but we shall see at its lowest, and it's always 6% from the high. So you have to set where that standard is. At the beginning of the year, down 6.8%. Is it since a year ago? 6.8%. You always have. That's always a moving target. So, we shall see.
Really, the market's not static.
You adjust where you measure to whatever agenda you're trying to create. You adjust where you measure. All right.
Your
so
agendas.
That explains a lot about you, Darin, but we're not going to go there.
We don't have time.
You should make the agenda. I would love to see a Darin agenda one week.
I'll be the only one talking. All right, so we talked. We kind of hinted earlier about the
karaoke songs.
There you go. There you go. Everybody now, Sweet Caroline. Let's go on and move on to inflation. We kind of hinted on it earlier with the Fed and the Fed speak and the Fed minutes, et cetera, and then all the governors will traipse out now and do their thing to move markets however they need it to move. But inflation is rising. So you're agreeing with what the minutes were kind of hinting to, Daniel? Is that what you're saying?
Yeah, Well, I mean, it's nothing for me to agree or disagree with. I know
the numbers are right.
Well, yeah, I know you don't believe the numbers, but we got to talk about something here, Darin. It can't all be fairy dust. So prices rose 0.2% in January, with an annual inflation of 2.4%, which is less than the expected 3% they had. So kind of going into this meeting, people were expecting more or less no rate cuts for the rest of the year, at least with Powell, still running things. And this is, kind of come in with consensus of that they can't really justify any more rate cuts, which, as much as I would love to run it hot, I don't think we need to overdo inflation with having inflation be such an issue really over the last 5 years. It feels like, starting in COVID when they printed a bunch of money. So, and honestly, I like seeing a 2.4% inflation less than the expected 3%. I'm here for that, I'll say it. Shout out Powell. He did his job.
Sorry.
This concludes our broadcast day. Thank you for joining us.
Powell, the best one ever. Fed president ever. Yay.
Whoa. I didn't say he wasn't wrong the last 4 years, but
Yellen.
Okay, well, she was Treasury Secretary.
I still like her better.
It's all transitory. Everything is always transitory. Oh, yeah. Which in itself is true.
Everything's a broken clock is right twice a day, right?
That is not true. That is a false statement. Only if it's not moving is it right twice a day. If it is actually moving, it is never right.
Well, okay, I guess I assume with that statement the clock is not moving.
What if it's broken and it's moving faster than it should?
Or slower. Yep.
All right.
Or slower, yes.
Asterisk, a broken clock means the hands are not moving. I don't get all technical and shit.
Speaking of not moving,
we do.
Good transition. Speaking of not moving.
Go back to astrology, will you?
Okay, we're going to build on the moon now. We're focusing on the moon now instead of Mars. There's your astrology for this week.
That's on the moon. What?
Oh, what? Elon doesn't want to go to Mars anymore. He wants to go to the moon.
He wants to go to the moon first. Far away. Yeah, and costs too much and takes too long. So we'll do moon first and then work on the other.
We got Arizona already, you know.
Yep, moon-like to take pictures of.
No, it's Mars-like.
Yeah, there you go. There you go.
Darin, I owe you one. Sweet Caroline is now stuck in my head.
Yes.
I have no one to blame but you.
Yes. Yes. All right. Bum. Here we go with homes are not moving. Yes, that's true. It's still the price, Daniel. Is it the rate, which did come down for a bit, but now if we're going to go back up, and it was like an SIR dot, it's going to now go up. It's going to reverse and go up with the meeting minutes that were shared. So what's going on with homes? Average price has come down a little bit, hasn't it?
It crept up only a little bit, but the sales of pre-home owned homes decreased by 8.4% from January to December, and sales were down 4.4% from a year ago. So just a small decrease in home sales, which, you know, with rates still being high relative to when people got their homes in COVID, it's probably a trend that is going to continue. And, you know, while people were kind of doing some of this on the internet, the market has about 3.7 months worth of supply, and we're only considered at an imbalance when you have 6 months worth of supply. So like we could double from here almost, and then we would just start to be considered like, there's a bit more on sale than we'd like to see in the market. And prices have only gone up 1%.
So
all things
go ahead.
I was just say, all things considered, like, you know, the housing market isn't in the worst place, at least from these numbers, whether or not they're real. Caveat.
So now I'm going to ask you a pointed question. When was the last time the real estate investment trust index has been at this level? When was the last time?
I don't know.
I'm going with 2008 or 9.
No, 2022. So we're at a double top right now.
Okay.
We're at a double top on the REIT, and surprisingly enough, yeah, I think it ugly. Extremely ugly.
Well, here's
only because yeah, go ahead.
I was gonna say the average age of a entry level buyer to mortgages and houses, et cetera, has gone way up. It's up like near 39.
It's like, it's like 40. Near 40, where like years ago it used to be like 27 or something.
Right. It's because these I mean, millennials, which used to be a big part of the house buying, they can't afford it anymore, and they're scared of doing any kind of commitment with the job prospects out there, AI taking over jobs, etc. They're scared to make a big purchase like that, so they're either moving in with each other in a rental situation, or they're just staying at home with mom, or going back home with mom and dad. So, yeah, I don't think the housing market is that great. For sure.
Yeah, no, it's going to get a little bit uglier. And what bothers me about all of this is they're talking about inflation, and basically they're saying everything's inflating. If it were actually inflating, the dollar would not be going up. The dollar index would be going down if inflation was actually happening. The fact that the dollar is getting stronger means things are actually deflating, which would be a reason to actually raise the interest rate. But y'all give mixed signals all you want, you know.
Well, we're skipping the stagflation. I mean, that's
oh no, you can wind up there if it doesn't move. Like if it stays within this 97 to 99 range too long, yeah, you get stagflation.
Yep.
because that means
All
no growth in the dollar for at least the last 3 years. Isn't that bad?
Right. Well, let's move on to. It's like Daniel and I are disagreeing on things today. How about that? He's saying AI. He's saying AI will create more jobs, and I say no, it's already taking away and going to have more and more people being laid off because of the entry level things that are being taken over by AI. So, what say you, Daniel?
Me or Daniel?
No, Daniel first, and then you. You're the recap.
Well, okay, let me present the news. All right, I'm not like presenting a hypothesis here.
Oh, okay.
That's like no.
Who paid you to say this? I need to know.
one of the 8 newsletters I read to make this agenda every week that Darin always dislikes. All right, so IBM said they're going to triple their entry level hiring this year. And the reason is because they plan to have all of these new people they bring in leverage AI in hopes of, more or less like 10xing their productivity. So the idea is that you bring in all these people to manage these agents that, more or less can do the work of 10 people. So you bring in one person and you have it then more or less, do the work of 10 people, so that their productivity is exponentially, higher for the company, and they're still an entry-level person, so they cost less. And so they're going to have these people coding or setting up the agents to code because
coding.
But you'll have the actual humans meet with clients, since robots, can't do that yet, as well as Dropbox saying that they're going to increase their internship and new grad program by 25%. So this is the first I've read of any companies having kind of a bullish stance on adopting AI, right? Most companies, like I think it's like Spotify and Shopify, have had statements come out from their CEO that they aren't hiring anymore. They want everyone using these tools and whatnot. So, it becomes a question is this the year where we become less negative on jobs and we realize agents are just multipliers of human capability? Or is this a kind of like a false flag and, AI is still going to eat all of our jobs? And a fact I'd like to point out is new entry-level jobs are down 35% from 2023. So they're at like some of their lowest levels, and youth unemployment is at some of its highest levels in a very long time. I don't remember how long, but
yep.
It's also big. China has an even bigger issue than the U.S. has with youth unemployment.
Well, they're ahead in robotics too. So, the Elon has said for a while now that, and that's why he started pushing for universal wages and stuff, because evidently we're all going to not have a job, but we're going to need a universal wage to still take money to live while the robots take care of everything. That was his big vision. Yes, Royce.
I have several things to say about all this.
Say them.
Podium's yours.
The main thing is basically, if we can use AI to make things more efficient, why don't we make all of our investments more efficient with AI as well? Meaning the assets that we have, the assets that we own, the assets that basically people spend their entire lives paying off a house. Why does that asset not have a return on investment until you sell it? So if you can figure out a way to leverage the asset that you have in your house, maybe it can actually be the thing that saves us from all of this silly Social Security not existing and XYZ. If you have, think about it. People have 300, 400, 5,000, 600, $1 million home. Why is it only worth paying taxes on? And you're insuring it to make sure it doesn't burn down, but you can't. You have to literally go beg to borrow from a bank to get the equity out of it. Why is that a thing? I think it should be something different. I think that overall, any asset that appreciates, you should be able to make money off of every single month.
I'm sure that program will present itself in the future. And and I guarantee you the investment houses and brokerages, etc., be 100% for it, because that will put more money out in the system for them to grab a hold of and to manage and to make money off
market.
of.
Hey,
yes.
Instead of a bubble popping, you're going, hey, let's actually make all these
and you'll
things.
have more people part of that. And it comes from the people and not from the Fed pushing more money out there from future generations. It's getting money from the current generations and just leveraging the amount of equity you have in your homes and the amount of your home and the value of your home, and using that money to invest again. So yes, I hope someone comes up with a program like that in the future. That would be awesome.
I would love to see that in the digital market side too. So it means you don't sell your house, your illiquid equity becomes tokens that you can spend every month to invest across the digital asset or side. Tokenize your house. Why not?
Yep. Okay, future soothsayer. Royce.
Hey, we're solving problems. If they're making everything efficient, make it really efficient. Who says a 50-year mortgage is efficient?
Right?
You can do better than that.
It's great for those that make money off of it, but not the owner. So let's make it beneficial for the owner, please.
Yeah.
Yes.
Don't be a reverse mortgage either. Like, oh, you're slowly stealing my house from me as it appreciates. Who thought this was a good idea?
Yeah. What was it? Tom Selleck. I remember his commercials about reverse mortgages. Preying on the older folks.
What I actually like about that house as an asset, right?
Yep.
Barring anything else, it's why make it where it is unapproachable. You got 40-year-olds who can't afford to buy a house, and basically said, hey, on Earth we only have so much land. If we only have so much land, make that the biggest, most driving asset that makes you the most money, and basically everyone has access to it. And your only limitation is how much land that you can buy, own, and maintain.
Yep, we need more people, the population, the citizenry of the U.S. to have more financial freedom. We'll stop it there.
I see what you did there.
All right. All right, Mr. Bitcoin Applehead, love Robinhood probably. What do you got to say about Robinhood? We mainstreams and apes hate Robinhood, by the way. Just letting you know.
Yes, well aware. Unfortunately, they still have the best interface of any trading
I agree
app.
with that. Yes.
Yes, quite unfortunate. But so Robinhood, last year I think it was either the best performing or one of the best performing stocks in the market. But it has had a big drop recently, especially after earnings, due to its exposure to how it makes money with crypto. So, crypto trading is down significantly as retail has been less interested since the October highs. And they are now, don't worry, Royce, you'll get to go. They will, or Vlad, the CEO, really sees event contracts being kind of the next retail super cycle to bring forth, more revenue to Robinhood. And to give you guys some stats on how popular prediction markets have become, is that Kalshi logged more than 1 billion contracts tied to the Super Bowl, and 871 million of that was trades put on Sunday of the actual Super Bowl alone. This is pretty funny. 100 million was on which song Bad Bunny would sing first. So of that billion, a 10 was just on which song would be sung first, which I thought was kind of funny. Wow. But so Royce, you can take this whichever way you want, but I just wanted to say one thing, because I think this shows kind of how bad the signs of a K-shaped economy is. And back to the points of when we're talking about AI and whatnot, of how much worse it could get. And, you know, crypto and gambling is kind of more specifically male, like young male dominated. And I think it's a sign of that, you know, kind of like young men are struggling to, you know, figure out how to like make money and make things feel like they're affordable for themselves. And they're, you know, kind of going towards gambling to make up the difference of, you know, how they can make money, because the spread between what is more or less going to become the haves and have-nots is becoming, it is big. And, you know, AI will potentially only make it worse.
Okay.
The floor is yours, Royce.
All right. So let's talk about Robinhood. Specifically, Robinhood and the stock market, right? Guess who came out with, I don't know, July 1st, 2025, a digital version of its stock? Anybody?
Robinhood.
Yeah. Hood X USDT. The Genius Act, right? Genius Act created and allowed, by the way, for you to say, you know what? I'm going to make a digital version of the U.S. stock market. One's controlled by the SEC, one's controlled by the CFTC, because it's a commodity now. And let's say I was the owner of Robinhood, and normally with the SEC, I have to declare when I sell my stock. On the CFTC side, not so much, because it's not regulated yet. So if you're seeing stocks half in price, because quite literally, Robinhood went from $150 per share down to $75 per share, but now you have the digital asset worth $75 now, as well as the physical stock. So that means you can play with Robinhood on the crypto side with CFTC, or you can play with it on the SEC side. But if I was another company, and normally when companies sell or shell out or get rid of, exercise whatever their shares are, you have to announce that to the SEC. When there are currently about 60 stocks that have made digital versions of themselves, and who knows who's bought them on the digital side of the house, because you don't have to report currently. Wait, isn't that March Clarity Act? Oh, that's coming. Never mind. As we were.
Yeah, I remember when transparency was a thing, but it wasn't. It just changes.
Being observant definitely pays. So
yeah, CFTC is also it's a rabbit hole to go down. But look at what they are responsible for now versus what they were responsible for 2 years ago. They've pushed a lot of things to the CFTC.
Absolutely.
And it'd be very interesting. It would take a month worth of blogs, Daniel, if you did one on that. Because the CFT has changed. CFTC, which when I'm back in the APE days, I always included them in my tags. The DTCC and the CFTC, all the guys. And the SEC GOV, all of it. So that's why I was so popular with those guys.
Well, you do know that CFTC is far larger than the SEC. I mean, like by orders of magnitude.
Especially now, it's even more. Yeah,
absolutely. Because now you're playing with cryptocurrency, you're playing with commodities, you're playing with the foreign exchange market. On an average day, you're trading $11 to $15 trillion per day in volume. Where, you get a few $1 trillion, maybe one or two, maybe. Most of the time, it's about half $1 trillion in the U.S. stock market. So basically, them expanding and being able to say, you know what, we're gonna try it with these guys. These are our pilots. Bring in those Mag 7, Don't worry about it. They're good. And let them commingle. Don't worry about it. They're good.
It almost feels like a second float to me.
It is technically. It is a second float because now it's not a one-to-one relation. Because two separate governing bodies are maintaining it. The physical security, the shares of stock, that's the SEC. The digital asset of being able to claim those shares of stock, that's CFTC. Completely different governing bodies, completely different rules. But that also means now there's probably going to be an equivalent to a Reg D or something type exemption on the CFTC side. Now that basically the stocks are trespassing over.
In 10 years, yeah.
No, sooner than that. Much sooner.
They
than
slow
that.
roll that regulation so bad because they need to take care of whatever they need to take care of before the regulation happens.
Clarity Act. Pay attention to the Clarity Act. Wherever it's at in the House and the Senate, wherever it's at, once it's passed, guess what? They won't make you go back and report, but for everyone who's been playing since July of last year to where we are now, that 8-month window of you guys are grandfathered in. As long as
let them do their thing
after the fact, you're fine.
Right. Grab your riches now before regulation. That never happens in finance. Okay.
If I get hit by a bus when I leave the office, know that I've said too much.
Could be all three of us. Yeah, we're done.
No one will find him. He's in Singapore.
And all of a sudden the video would disappear. Yeah, no kidding.
You just doxed me. What?
That's right. It's a big city. Let's go
it's
to
tiny. Every single state's bigger than this country.
I'm trying to help you. All right, so let's go to these tech bonds and honestly, are we on the way towards because you talked about junk spreads, etc. I want to say that's the CFTC is becoming responsible for all those swaps too. But this is what happened in 2008 and 9, right? I mean, we had problems with junk spreads and junk bonds, et cetera, et cetera. What are you talking about here, though?
Well, so Google just raised $32 billion in under 1 day to finance their increasing capex spend, like most of the Mag 7, right? That's not news. But they issued a 10-year bond. 100-year bond, and it was 10 times oversubscribed, right? So that means that, they could have raised way more money because, the investors want it. Now, there's a few caveats to that, but just to paint the whole picture, last year, tech companies raised $710 billion in bonds, and this year they're estimated to do $1 trillion. So this could be a bit distorted by the fact that a lot of these bond, passive ETF bond funds are just automatic buyers of anything in their particular credit area. So, if they want AA credit rating bonds, they just buy anything that's on the market. So a lot of this stuff is getting bought up potentially much quicker than it historically would have as these funds become quite big. But the one thing that I like to note, and I've mentioned it a few times on here, and I'm not saying these are exactly the same, but they are some parallels, is that something that also marked, one of the early signs at the top in 2000 was an increase in companies building their leverage in their business model. Now, big difference is, we're talking about companies like Google, Oracle, Amazon that are, companies that make money, have real business models, and are just leveraging on promised future revenues. But it is something to note that when these companies that were called asset light for the last 15 years and kind of cash cows are now going to bring leverage into their business, either, how big they think AI is going to be, what they need to win, but also, you might be seeing reflected in everyone's stock price of what investors want to see as a return on that money before they get bullish on them again.
All right. I think there's really nothing else to comment on that. I don't think, because it's all future stuff, like way future.
We like the
Besides, but it does kind of go into the next thing, which is talking about capex and that's really what has made all these investors, at least that's the story out there, is that too much is being spent with capex, and it's going to cost too much to even get close to start making money on what's been promised. That's the way I understand it. Anything you want to say about that, Daniel? You can get a little more.
I mean, it's just the Bank of America fund manager survey was saying that, more or less these fund managers are starting to think that the CapEx expenditure with a lot of these, Mag 7 companies is becoming too high relative to their cash flow, and that they are starting to see AI as a tail risk to their portfolio. And you see this with CTA positioning, that they've gone from 100% exposure only 2-3 months ago to now 60% exposure to equities. And typically CTA funds, they're trend followers, right? So they only reduce exposure when the trend is down. But because the market has been so choppy, and volatility has increased so much, they've had to reduce their exposure as a whole. So you're seeing them kind of lighten their books so that any kind of downside risk, they're not as heavily positioned in to reduce anything. That being said, sometimes these CTAs get it wrong, right? So I'm not going to sit here and say that this is some kind of big market tell. I've seen the CTA exposure chart be, at its lightest at the bottom when they should be going the longest, and then the longest at the absolute top where they then get their face ripped off. But they're trend followers, right? So that's kind of how their exposure goes. But an interesting note on all this is that Asia this year has seen the strongest inflows from hedge funds in the last decade. And that, I don't know if I made it a prediction, but it's kind of like a theory I had at the beginning of the year, is that because, I know we have a lot of repatriation of, from dollars to local currencies in Europe and whatnot, but there's just no growth in that particular market. But I do think the only, I'll call it the last frontier outside the US is Asia. And that's because of robotics, AI, EV, all that kind of stuff. They're really the only new tech forward country other than the US. So I think that's a trade for people to watch out for, or I should say a theme, because you can't trade Asia as a whole.
Well, and it also got smacked down so hard. So it's.
I mean, yeah, for like 10 years, and
exactly.
So it's bound to
room to grow. In other words, it's not at all-time highs like the U.S. is, and way over.
Well, actually, it is, but the valuations are way less rich.
Yep. Is that a monetary thing?
Yep. All right, guys, I'm gonna have to go, but I did win last week. I want to use Bud. The range is between 83 and 76, and I am taking, let's say 77.50.
It's a $7 difference split between four. You're making this hard.
$1.75. You got this, right?
Well, yeah, but you still, you could go ahead and make it $8, and we both get two. I'll get two. So.
No, that messes up my numbers. Remember, I won, and I have to do this 3 more times to beat Josh. So,
yeah, right.
And I'm taking the bottom of the range, but I got to jump, guys.
All right, so you're at the bottom. I got you.
I'm at the very bottom. All right. Appreciate you. All right, thanks. Bye.
All right, see ya.
Bye.
I gotta get another picture of, like, the picture I put of you. Whenever you pop out, that really young one, I need to get one of Royce to stick in there.
What was his range? I didn't even.
It's $1.75 each. So we're going from 76 to 77.75, 77.75 to 850, 850 to 925. Is that right? No, he said 83, 76 to 83. Seven. Does that add up?
I don't know. He said it so quick and then got off. I didn't follow.
All right, hang on. 76 to. He said
I'll do the
76.
range above him. I'm his team member. You and Josh can duke it out for the above, and you can confirm the ranges with him later.
Yeah, that's true. That'll be a lot quicker.
I mean, I would just confirm. Yeah.
That puts Josh at the very far end, away from
put Josh at the very
Royce,
top,
which actually makes sense, and would probably fulfill what he planned. Anyway.
Yeah.
All right. Well, I'll figure that out, and I guess just the two of us. I got to put a song in there.
I know you do. You can't help yourself.
Yeah. So until next week, hopefully Josh will join us again. You've got Daniel and Darin. This is not a deep dive, but it is the ending of After the Bell. So say bye-bye.
Bye-bye.